Welcome to module number 3, where we are going to explore another new requirement on the presentation as per IFRS 18. This requirement is related to the critical accounting judgments. IFRS 18 requires companies to provide more detailed disclosures regarding critical accounting judgments. These are the judgments made by the management that have a significant impact on the amount presented in the financial statements. Here are some examples of the critical accounting judgments a company might encounter and how IFRS 18 emphasizes their disclosure. Number 1, impairment of assets. Management must assess whether an asset is impaired, meaning its carrying value exceeds its recoverable amount, as we explained in IS number 36. This involves estimating the asset's future cash flow, which can be subjective. So the disclosure here under IFRS 18 regarding the impairment of the assets will include the following: the key assumptions used to determine the recoverable amount, the sensitivity of the impairment loss to changes in those assumptions. So, for example, you might say, how much would the impairment loss change if the discount rate used in the valuation increased by 1%? And also the impact on the profit or loss and other financial statement line items if a different judgment had been made. So this is one example of how critical accounting judgment under IFRS 18 is made. And this example was about the impairment of assets. Now let's go to another topic relates to the accounting judgment as well. Revenue recognition. Companies need to determine the point at which revenue is recognized and the amount to be recognized. This can be complex in cases of long-term contracts or where performance obligations are satisfied over time. The disclosure under IFRS 18 will be the following for the revenue recognition: the specific accounting policies used for revenue recognition, the nature of the performance obligations in significant contracts, and the amount of the revenue recognized for different types of contracts. Another example for the critical accounting judgment under IFRS 18 will be related to the fair value measurement. Some assets and liabilities require fair value measurement, which involves estimating their market value based on assumptions about future market conditions. So the disclosure here under IFRS 18 will include the following: the company should disclose the valuation techniques used to determine the fair value, the key assumptions used in the valuation model, including the reasons for choosing those assumptions, and the significant inputs to the valuation model, such as discount rates, growth rates, and their impact on the fair value estimation.